Now we can talk about that controversial topic, rising interest rates.
Sure.
Yes. So what type of impact do you think that it's going to have on housing market?
So I have my own personal theory, and it is a theory.
That's what I'm asking. Actually,
I could be completely wrong.
It's not a financial advice.
None of this is financial advice.
None of this is financial advice. This is just two friends discussing.
You can call me for financial advice, but this is not financial advice. No. So my personal theory is that in the next 12 to 18 months, we are likely to see an increase in rents, and we are likely to see a drop in house prices.
We already started to see increase in rents and dropping on the
and it will only get more exaggerated.
Okay.
And the reason I'm saying that is I think the number of people that have got a buy-to-let property, so a property that you've purchased to rent out to a third party, is the number of those people that are coming out of their current deal that's at a relatively low interest rate, let's say 2 or 3%, and they're going to find their interest rates north of 5%, and that just affects the entire economics of their business model and may make that business model not feasible anymore or significantly less attractive. They may choose to cash in on their property, sell their property, take the capital gain and go and do something else with their money because it's easier than being a landlord. What that does is it reduces the supply of rental properties in the market, so that forces rents up, but it increases the supply of properties on the market to be sold. So that reduces the pressure on prices. So we might see some decreases in prices as a result of that. Obviously, this varies area to area. So depending on where you're based, you may see prices generally increasing, but in other areas it may drop off much more significantly. That's my pet theory as to kind of what's going to happen in the next 12 to 18 months. But we'll have to see kind of how that comes about. As for generally how things are how interest rate rises are affecting the mortgage market in general, the way that lenders react is they tend to overreact to any given external factor. So in this case, they overreacted to Liz Truss kind of trying to blow up the economy. And as a result, interest rates kind of went sky high, and then now they're returning to mean. The reality is I don't think we'll see record low interest rates anytime soon.
Yeah.
I think we're more likely to come to what sort of historical norms. And people have to get used to paying it again.
What are those historical norms? What's the range that you can...
In the UK, I think
4 or
it's
5%.
Ballpark 4 or 5% is kind of generally where people think about. It depends on how much deposit you put down.
Yes.
So one thing to mention is the more deposit you put down, the lower the interest rate is going to be from a lending perspective. But that the range of how much it can drop has also reduced as a result of kind of rising interest rates as well. But the Bank of England base rate doesn't directly affect the mortgage market because the lenders that borrow in order to fund their lending, they borrow on the money markets. They borrow, and so swap rates are actually what causes more fluctuations in the mortgage market than the Bank of England base rate. What you'll also see is that lenders will increase their interest rates when they want to reduce the flow of business into the flow of volume of business. So they will always constantly play around with that so that they can manage their service levels. What that basically means is when I send an application to you, how quickly can you deal with that? How long is it going to take you to deal with that, essentially? So they want to manage that timescale so that it doesn't get dragged out too long. So they will increase their interest rates to manage that and take in less business when they're very, very busy.